Okay, good afternoon. Good afternoon. It is really nice to see so many familiar faces. I'd like to welcome you to the Lodge on the Desert for our 2014 Executive Ethics Symposium. I'm already working at a deficit here. The mic does not go up a little bit higher, so let me know if I need to move forward here. My name is Paul Melendez, and I have the real pleasure of serving as a faculty in the Department of Management and Organizations. And I'm also a very proud founder of our Center for Leadership Ethics, a center that's the first of its kind not only in the college and at the university, but a center that is markedly different from any other centers that you find in top business schools. Our overall mission is to improve organizational ethics, and we do this by strategically focusing on three areas: education, research, and outreach. On the education front, we offer a whole series of courses to undergrads and grads related to business ethics, corporate social responsibility, and governance. On the research side, we are doing some wonderful things with applied research that have gave us some rather interesting findings in the healthcare space, compliance, and even with integrity tests. And when you look at our outreach programs, we have some of the most innovative. We have programs that focus at the K through 12, the collegiate, and the executive levels. At the high school level, we have this thing called the High School Ethics Forum that we run every year. At the collegiate level, the nation's biggest, and I would say best, collegiate ethics case competition. And today we find ourselves here doing our 2014 Executive Ethics Symposium. As you could probably imagine, these programs just don't happen overnight. There's a lot of people that have pulled together to support us, and of course we have sponsors that have allowed us to run today's program. So I'd like to single out a few people and a few groups. First and foremost, can I please have Ann and Lauren stand? Ann, Lauren, to our staff, thank you so much. They are ready to run for the hills at the end of today's program. I'm sure they are tired of the emails and the constant back and forth, but thank you both, Lauren and Ann, for your wonderful work. I'd also like to ask both Jaron and Amelia that are representing our Net Impact chapter to please stand. Thank you both. About 9 months ago, we began to have a discussion about potential topics, and when I raised this one, you should have seen the look in their eyes. They got so excited, and they actually did the hard work of initially reaching out to a few of our panelists that I'm going to get to introduce here shortly. So thank you both for all of your support. I'd also like to ask Stephen and Alex to please stand. So Stephen is our Executive Director of the Center for Leadership Ethics. He's also a professor in our department, and Alex is a professor in our department and the Research Director for our center. So to both of you, thank you for all of your support. And we have something new and very exciting that I want to share with you. We just established an advisory board for the Center for Leadership Ethics. So I'd like to recognize each of our board members. I'd like to start with Ron Sable, who's our chair. So Ron, if you wouldn't mind taking a stand. Ron. Frank Broyles. Russ Johnson. Where's Russ? Adriana Kong Romero, who's not here today, but she's a market president for Bank of America. So Adriana, I know you're away, but Matthew Sesto. Kimberly States. And Doug Zanes. Doug. Thank you all for what you're going to do in the coming year and in the coming years. I'm really excited about this next chapter in the center's journey, so we look forward to your membership, and immediately following our symposium, we're actually moving into our first board meeting. So it's going to be a lot of heavy lifting before we all make our way to a long weekend. I'd like to also take this as an opportunity to recognize our two very important sponsors. At the silver level, although Mr. Ramirez isn't here, I'd like to thank Mr. Ramirez, who's the president with Vantage West. So a round of applause to Vantage West. And for our gold sponsor, Doug Zane with Zane's Law. Doug, thank you so much for the generosity. I'd like to give Doug an opportunity to come up and say a few words to you. So Doug, please.
Just want to, can everybody hear me? See, Ron, I don't think Paul told me I'd be pinned to the corner and I couldn't work the room, but this is very important to me in particular, but I think both my wife Claudia and I, we're big supporters of the program at Eller. We find ourselves in an industry. For those of you who don't know us, we have a law firm. I'm a lawyer. Claudia's the business person. She's the CEO of our practice, and I'm the guy that takes care of the attorneys and the legal end of the practice. And it's a highly regulated industry, quite honestly, that really doesn't believe in having non-attorney management to run the business end of the practice, because the belief is non-attorneys will somehow create a scenario where I, as an attorney, or the attorneys that work with us, are doing unethical things. And it's been interesting over the last year or so as I've gotten to know Paul and gotten to know Ron and become active with the program. It's made me think a lot about ethics. And one of the questions I quite honestly came up with is, why at the age of 44, 17 years into a legal career, am I really thinking about ethics for the first time? It was kind of astonishing to me. And again, between undergrad and between law school, I think a lot of people would say I probably have more education than most people need. And in that entire education, I can think of one ethics class that I took in law school, and it had nothing to do with ethical decision making, but it was, here's how you pass the ethics part of the bar. So I think this program is an astonishing program, because when you look at what goes on in our world and the decisions that people make, whether it's professional athletes who lose a career because of the decisions they make, or because of business people who don't take care of their finances the way they should and hide it, Ponzi schemes, all these different things, the question always comes back to, why would you make that decision when you could most likely be hugely successful even if you had made a different decision? And I think that's where this program is trying to make a difference, starting with young kids, high school kids, college kids, MBA students, because the real issue is, when you make a decision, do you actually consider the ethical implications or ramifications of that decision? And I think with the way our educational system has been set up to this point, we have a tendency to look at decisions, especially in the business world, from a money-making perspective. And we don't factor in the ethical piece. And that's why someone will look the other way because it benefits a coworker. Or it'll look the other way because it protects the reputation of their boss. And so I'm sincerely looking forward to the next few years being part of the advisory board, but I'm grateful and appreciative that all of you guys would come out today to support the program, to support the symposium, and to be hopefully positive message bearers when you leave here today for the program, for the Eller School of Business, and for ethical decision making as a whole. Thank you.
Thank you, Doug. We also have a special guest, our very own Dean of the Eller College of Management, Len Jessup, who is here with us today, and I'd like to give Dean Jessup an opportunity maybe to say hello and whatever else he'd like to say. So Len, come on up. He is my boss, so whatever he wants to say.
Thanks, Paul. Just a couple of quick words. I'm just going to come out here.
Okay.
I'm Italian. I work better if I'm moving around. Yes. Paul and I kid each other because we try to one-up each other with metaphors that we use. And so he had a great one within the last week or so. And he said he was referring to somebody, a group, I can't remember, one of our programs within Eller, and he said, that group is, I think it was hitting above its weight class.
Punching above its weight.
Punching above its weight class. And I don't even know what that means, actually. I had to look it up, and it sounds like that somebody's just doing amazing things where you wouldn't expect it, and they're maybe without the resources they either have themselves or the resources they have available to them, that they're kind of doing more than you would expect with the resources and what what they've got to work with. And I think that probably fits pretty well for what you've done and what everybody else has helped with our ethics center. It really has become not only very innovative, but really world-class in a number of ways. As you kind of alluded to, I think you're being humble about it. Really, really proud of what we're doing in our center compared to what a lot of the other business schools and some really good business schools with a lot of resources are doing with their ethics centers. I think we're competing very well, punching well above the weight class. So I got it. Thanks. Good. The other thing I was going to say is just really exciting time in Yeller College right now. You know, when we kick off the school year, it's always an exciting time with a new crop of students coming in. We're also coming off on the heels of a very successful school year last year. We saw, for example, some great traction in U.S. News and World Report on rankings. Our undergraduate program, which routinely ranks in the top 25, moved up in the top 25 a bit, which is really difficult to do when you're at that altitude. And our MBA platforms also have been doing really well on U.S. News over the last several years. And last year in particular, our evening MBA moved 21 spots. I'm looking at Hope and Christy. I think it was 21 spots in one jump, which was just unheard of. Honestly, I've never seen anything like that in my 30 years or so doing in this business. And so, and a lot of other great things, the launch of new programs, and a lot of excitement and accomplishment last year. And then I think because of that, this year we've got a huge crop of incoming students. The biggest ever we've seen really ever in one time at the undergraduate level for incoming freshmen and transfer students going through our pre-business. And then also at the graduate level too, in the master's programs, and especially within the MBA program, we're seeing great enrollments across all those platforms. Full-time MBA, evening MBA, executive MBA, and now an online MBA that we offer, all growing nice and really well. So pretty fun time in Eller right now. I'm in game day stuff because we have a football game tonight, in case you hadn't heard. So hopefully I'll be seeing many of you at the game tonight. And the way my life goes, I put this on in the morning, and this will be on me until whatever, 11 o'clock or whenever I get home after the game tonight. So no time for wardrobe changes for me throughout the day. Anyway, hope to see you all at the game tonight. Really excited. We're looking forward to seeing what Rich Rod and the team has in store for us this year. So thank you. Thanks, Paul.
Okay, so before I introduce our panelists and go over the format, I want to give you a little history. Back in 2010, when this concept started, the original goal, and I'm looking at Stephen here, was to really demonstrate thought leadership. We really wanted to bring issues, ethical issues, to the table and really share it with friends. And when I mean by friends, they're friends to the center, they're friends to the college, they're friends of the university. And we picked a wonderful topic. How many of you remember our topic from the symposium in 2010? Well, let me remind you. You remember? The morality of a strategic default. So this is when you experience negative equity and you have the ability to pay. What to think of individuals who walked away from their mortgage. It was a wonderful way to start out the symposium, and we thought we had a lot of success. 2 years ago, we ended up discussing the benefit corporation movement. B Corps, I'm glad to update you, as of this past May, are actually a legal entity that are allowed in Arizona. Governor Brewer signed off on SB 1238, and so at the time when we had the 2012 symposium, we wanted to share this movement. And it's actually taken root here in Arizona. This year, we're going to talk about alternative investing. And I shared this with Stephen, and I think I may have shared this with Dan and Stephen a little bit earlier. The timing's impeccable. Literally last night, I received an email from an organizer. And he's heading up an effort that is referred to as Divest U of A. And in the message, this organizer said, Professor, we'd like to approach you and see if we can share a message with some students, give them some career internship opportunities to try to mobilize an effort to get the university to divest its endowment from the top 200 fossil fuel companies. Now, I was so curious. I got a hold of this list, and it is a who's who. I mean, we have the US ExxonMobil, we have Australian BHP Billiton, we have the UK BP, we have the Dutch Shell Corporation, and for those of my undergrad and MBA students, all the BRICS are represented. And for the MBAs, they know what BRICS are: Brazil, Russia, India, China, South Africa. You've got Petrobras, you've got Gazprom, you've got Tata Steel, you've got Sinopec, and you've got Sasol. All of those are kind of national champions that are either in the coal, gas, or oil industries. So just think about the timing. More importantly, think about how, at this particular point in time, this discussion is really important. One of the things we've been doing a lot in management, not only in the classroom, but in a lot of consulting work, is talking about the generational differences that exist from a management standpoint. When you think a little bit about the millennials, the Gen Xers, the baby boomers, what does this mean from a management standpoint? What does it mean when people have very different experiences based on their life experiences, their values, their preferences? Well, I've got some thoughts, but I'm going to hold them, that I suspect from a generational standpoint, people have some very strong opinions about this concept of alternative investing. So that's what we're going to get to tackle today. Now, here's the format. We've got three really distinguished panelists today that are going to share their insights. I'm going to introduce each. They're each going to have roughly 15 to 20 minutes. What we'd like to do, if possible, is have you try to hold your questions to the very end so that we can work our way through the presentations. We've budgeted time in for a really nice Q&A session. So with that, I'd like to go ahead and introduce each of our panelists. And I think you will agree these are very impressive individuals. So the first person that's going to kick off this year's symposium is Stephen Lindenberg. So Stephen, if you wouldn't mind standing, please. Stephen provides strategic vision and direction to guide the firm's policies at Domini Social Investments, centered around policies, procedures, and daily practices. He oversees the integration of Domini's social environmental standards into its research processes and into communications with shareholders, corporations, and the public. Stephen previously served as the firm's chief investment officer, vice president of Domini Funds, and was co-founder of the Domini 400 Social Index, the first index to utilize social and environmental standards. Stephen has been active in social research since 1975. He's written a number of articles and books on responsible investment and corporate social responsibility, and he's also the founding director of the Initiative for Responsible Investment and is a member of the Boston Security Analysis Society. Mr. Lindenberg holds a BA in English from Columbia College and an MFA in Theater Arts from Cornell University, and he holds the Chartered Financial Analyst designation. How about a round of applause for Mr. Stephen Lindenberg? Following Stephen's presentation, we're going to have Mr. Dan Ahrens, who's the Managing Director and Chief Operating Officer with Advisor Shares Investments. Dan has extensive experience in the investment management industry, covering portfolio management, sales, and administration. His background includes responsibility for operations, finance, and compliance. Prior to joining Advisor Shares, Dan founded Vice Fund in 2002. Dan is an accomplished author and speaker and has appeared on numerous financial programs, including CNBC, ABC News, and Bloomberg. I love this next part of your bio. He is also the author of a book titled Investing in Vice, the Recession-Proof Portfolio of Booze, Bombs, Bets, and Butts. He was clear to point out butts were cigarette butts. He has been featured along with funds under his management in major national and trade publications, including The Economist, The New York Times, The Wall Street Journal, among others. He has a BBA in finance from Texas Tech University. Dan lives in Dallas, Texas. So how about a warm round of applause to Mr. Dan Ahrens. And our final panelist, Chris Lamoureux. Chris attended graduate school at Syracuse University, where he earned an MBA, a master's in economics, and a PhD in finance. Chris joined our faculty at the University of Arizona in 1994. In 1998, Chris became the head of the finance department, a position that he held for 13 years. During that period, Chris served on the investment committee of the University of Arizona Endowment. So I'm sure Chris would have a few thoughts on the Divest UA movement. As head of the finance department, Chris started the Masters in Finance program and co-developed a year-long course sequence in business math. Chris's research interests span the whole gamut of financial economics, from forecasting volatility using options and historical stock returns, to estimating models of term structure of interest rates, to modeling managerial issuance choice. Since 1991, Chris has been an associate editor of the Journal of Business and Economic Statistics and has always been interested in bringing new statistical tools to interesting financial questions. In my opinion, Chris also is perhaps the most interesting man in the college. There is not a topic, a language, an issue that he cannot intelligently speak on. And I've seen this play out year after year after year. He probably has not noticed that I've noticed, but I have. So Chris, thank you for being part of our panel. So with that, we're going to go ahead and begin things with Stephen Lindenberg with Domini Social Investments. So Steve, we'll give you an opportunity to come on up. We'll get your PowerPoint ready, and we'll get you set.
I'm going to use this handheld. I don't speak loudly enough, and I don't hold the microphone closely enough. So if you can't hear me, let me know. I want to thank you all for the opportunity to appear at this event associated with the University of Arizona. And I want to thank Professors Paul. I want to thank Paul and Chris for inviting me here, and I want to congratulate the Eller School and the ethics program for thinking of the topic of responsible investment. It is a increasingly important topic worldwide. It raises a host of interesting issues, and I think it is fruitful territory for thinking about ethics, finance, the relationship between finance and society. I want to share a few thoughts of my own on this topic, why I think it's important this day, why I think it has grown to this worldwide dialogue that's taking place about it, why I think it actually has the potential to influence mainstream finance in a significant kind of way in coming years in the 21st century, and then convey to you a little bit about Domini, where I have worked as an example, a specific example of one company that's worked in this area. I'm going to go through a lot quickly. I apologize. I want to cover some of the important points here, but there will be time in discussion. So let me just put this down here so I can see how little time I have left as I'm going along. So with that, let's get started. I just want to start first with just try to answer the question, what is responsible investment? Because there's a great deal of vocabulary associated with it that's come to become associated with it over the years. In the 1970s, socially responsible investment and ethical investment were the terms of art. In the 1980s, triple bottom line, double bottom line, and sustainable investment began to be used. Double bottom line and triple bottom line particularly wanted to call attention to the fact that you have to balance the social and environmental considerations with the financial considerations. That's what the second or third bottom line meant. Sustainable investment reflected the increasing interest in environment, particularly coming out of Europe. Then in the 1990s, best of class investment and ESG, meaning environmental, social, and governance investment, became widely used terms, in particular in order to make this concept, translate this concept into the vocabulary of the institutional investment market. And then in the last 5-6 years, impact investment has become a very common term. It's associated with social entrepreneurship, and basically it talks about getting investment down to small enterprises that have direct impact on people's lives at the local level. All these things, although there are different takes on responsible investment, have as a common underlying theme that when you make an investment, in addition to the financial considerations, it does have social and environmental implications. And your responsibility as an investor is to acknowledge those implications and, secondly, decide if those implications require some kind of action. Now, the action could be simply communication on the issue. It could be divestment. It could be starting a new kind of product line. But and not all social and environmental issues that are raised by investments require action. So that, to me, is what responsible investment is. It is understanding there are social and environmental implications to what you're doing and understanding the range of options you have to act. Oops, that's the wrong thing. Just to give you, dramatize briefly the growth of this, when I started in responsible investment back in the 1970s, there were a handful of mutual funds. There was basically nothing invested in social responsible investment. What was happening then was an adaptation, a testing out of certain methods. Religious groups had divested of the vice stocks for many years. The idea occurred to social, in a sense, social activists of divesting on other grounds than purely alcohol, gambling, and tobacco stocks, military, environment, other reasons. And folks like Ralph Nader and a community activist named Saul Alinsky discovered that you could enter into dialogue with corporations using proxy voting and attendance at annual meetings. That was just 10 years. People were testing that out. Nothing much happened except for filing of shareholder resolutions. In the 1980s, the South Africa divestment movement started up. And the South Africa divestment movement was the first indication that institutional investors, under certain circumstances, would be willing to act on certain social issues. And really, a responsible investment was South Africa divestment in the United States, and that was essentially it during the 1980s. Still, other investments, very small. 1990s, from the 1990s on, something happened. It expanded to Europe, sustainability became an issue, and since the 2000s, it's become a topic of worldwide discussion among institutional investors, and any major investment firm these days, any major bank, any major investment house, if you go into them and you have a portfolio these days, their answer today is very different than it was in the 1970s and 80s, which is, forget it, it won't work, we don't do that. Their answer today is, we understand this, if you want to do that, we'll help you do that. Today there are, depending on the numbers, there are trillions of dollars invested in one kind of way or another in this way. The United Nations Principles for Responsible Investment is a coalition of pension funds and institutional investors representing about $35 trillion in assets that have signed on to certain principles that say they will take social and environmental issues into account in their investment process. The CDP, used to be called the Carbon Disclosure Project, is a coalition of investors who say they want more information on social and environmental issues. They have about $100 trillion in assets represented among their membership or endorsers. Social responsibility data is being disclosed by 4,000 companies worldwide and probably is going to be mandatory. 1970, from nothing to today, tremendous growth. I don't want to exaggerate. Fundamentally, companies are not being managed, with relative few exceptions, dramatically different. Investment is not being made dramatically differently, but the potential there is there for the first time in my mind for real change. Why has that happened? What has driven something that was really just an obscure sideline to something that is really being considered seriously around the world? I think there are three themes here that are important. First, the consideration of issues of social justice, which came out of the 1970s and 80s of responsible investment. That's still with responsible investment today. Second, very importantly, the deregulation and privatization of industries around the world that happened in the 1980s and early 1990s. Government let go of huge swath of business that had been government owned and seized corporate social responsibility and responsible investment as a form of soft regulation, a way of directing corporations and investments to more responsible activities in a way that saves them from having the burdens of ownership or regulation. And today there are a series of issues that get to the third thing, which I would say responsible investment is viewed as something that can create shared value. And I'm going to talk a little bit more about this in detail, but basically there's a distrust of finance today. There is a understanding that sustainability issues, you can make money on them these days. There's an understanding that our environment is under stress and strain these days. There is an understanding that there are going to be 9 billion people in the world, and problems are going to be very complex, and you need everybody working on these problems together. And there is an understanding that as 1 to 2 to 3 billion people come out of extreme poverty, they are going to have the legitimate demands for access to medicine, access to finance, access to IT, to technology. All those are things that corporations and investors can help with, and there is the recognition that that is what is driving responsible investment, that together, working together, in order to address the problems of the 21st century, we're going to have to create something called shared value. Shared value is something that is the term was coined by a fellow named Michael Porter at the Harvard Business School. It has a fair amount of currency these days. It's a useful term. This is a chart that Jane Nelson at the Kennedy School developed, which I think is very helpful. Business as usual is, and I'm going to call this 20th century business, is compliance. This is Milton Friedman. Whatever, obey the law, and if you want to do good, if you want to add value to society, you can do philanthropy, you can do charity. Okay, that's business as usual. If in the and I'm going to call this 21st century business, there is a competitive advantage now to be built by taking what was just simply compliance, which was essentially government mandated, and doing something that goes beyond what the government mandates to understand your risks, the cost to you, the negative impacts that you can have, and the kinds of issues of climate change, water scarcity, etc., that you're going to be. Don't wait for government to regulate these. Get ahead of these issues. Understand these issues ahead of time, and you will add shareholder value to your corporation if you get ahead of those issues. What is hardest here is this idea of creating shared value. This is no longer charity. This is enterprises, and I'll give you some examples in a moment. Enterprises that affect your basic. This gets to the core of how your company is managed. You are doing good because you are not only building competitive advantage to your company, but you're solving or addressing social problems. That is the 21st century version of charity. It is no longer simply that. This is not easy to do, but this is, I think, where we're headed, and this is what the 21st century really will require of business and investors. So let me just give you just very briefly some examples of what shared value might be. How can you change corporations from their business as usual to something that is more complicated, more nuanced, and creates value? I'm going to give you some examples, and again, I'm going to rush through these. We can talk about them more if you want later. Coca-Cola. You probably have seen a fruit drink called Odwalla around. I usually bring a bottle of it to show people, and you will see Coca-Cola's name does not appear on this anywhere. Coca-Cola will tell you it is addressing the. Coca-Cola has a problem. There's the obesity problem. It's selling sugar water. You know, what can it do to show that it's doing something socially beneficial? It has a lot of reduced calorie, calorie-free, 0 calorie, and so on. They will talk about those publicly. They don't publicize that they're doing this. This is essentially a product that is competing with their core product. They see that they need to be in this area. They see that this is a kind of vehicle. They know incremental change may need to take place. Gap is working on vendor standards. It knows that it has problems overseas, like a lot of companies. It has to change those. They work with its vendors over time. This takes years. This takes decades to do. Yeah, but it is willing to do this slowly and work vendor. Ford, very interesting thing with its F-150. This is not only the best-selling Ford product. It's the best single. I'm sorry. This is its truck. It's flatbed truck. This is not only its best-selling product. It's the best-selling vehicle in the United States. Ford wants to get ahead of the issue on fuel efficiency. What is it doing? Well, it is going to take all the steel out of the F-150 and replace it with aluminum. So make it 800 pounds lighter. A major gamble by the company that this will not affect its consumer base, but it is willing to do this because it will increase the fuel efficiency of the car. This is the kind of incremental change that most companies have to make. There are two other ways of going about this, creating shared value. I've put examples of two Dutch companies, Unilever and Philips. The Dutch are particularly thoughtful in this area. Unilever has declared that its target market going forward is going to be the bottom of the pyramid. It's going to be the 1 billion, 2 billion poorest people in the world. They're going to sell soap to them. They're going to sell their hygienic products. It increases hygiene. It's a new market for them. It addresses a social need at the same time as it is a profit generating. They hope to double their business. Philips, the electronics company, got in early on LED lighting. They saw that as a competitive advantage, and they now dominate the market, and it is one of their primary markets. Patagonia, I'm sure you all know Patagonia. It is a company that just has environmental stuff throughout, outdoor sports stuff. My point is that these are companies that are willing to make systematic change in this area. And then finally, the third path to shared value is companies that just simply in their basic product area, right from the start, are in alternative energy, solar companies, water, addressing water scarcity issues, healthcare, etc. Those are sort of an easy way. I mean, not easy. Nothing is easy in business, but this is a way in which the business model and the shared value model are very easily aligned here, there. So that's by way of that. Now to turn to responsible investment. How am I doing? I forgot when I started. I'm sorry, return to responsible investment. Responsible investing really takes three tools it has to, and the goal of responsible investment is to make corporations and I'll talk about other asset classes, other providers of financial services and investment opportunities more aligned with this creation of shared value. And it has essentially three tools. One is setting standards, and that means emphasizing companies with positive attributes or excluding companies with negative ones. It engages with companies. This is the communications, which has been part of social investing from the very start. Direct communications with companies on that to improve their policies and practices. And finally, in the U.S., this community investing has been part of social investing from the start. This doesn't apply so much for equities, but it is part of other aspects of it. Responsible investing now has received its most publicity about equities. However, it is now beginning to infiltrate other asset classes. Products are being developed in virtually across every asset class that have a responsible a shared value. Let me put it that way, a shared value overtone. And in cash, you see the whole development of microfinance. In fixed income, there is a world of green bonds that has just been being developed in the last year or two. There is another world called social impact bonds that also has been developed over the last couple of years. In real estate, you see an increasing emphasis not only in the investors such as the major pension funds on energy efficiency and energy efficient real estate, but you see municipalities requiring energy efficient commercial real estate being developed. In infrastructure, you see the whole movement toward livable, walkable cities. In commodities, you see agriculture, you see sustainable agriculture, sustainable fabric, so cotton, sustainable forestry are all investment opportunities now. Private equity, you see some large private equity firms like KKR starting to dabble in this territory. I wouldn't say it's been very dramatic, but there's starting there. And finally, impact investments, which is the whole social entrepreneurship movement, really taking off, particularly among the upcoming generations. So responsible investment is just sort of percolating throughout the investment community. I'm not going to spend a lot of the time on this slide, but it raises three really complicated issues, but it's important. I want to convey to you three things that I think that will need to change if responsible investment is going to make a fundamental difference in the mainstream. If the mainstream is going to change, three things will happen. First of all, mandated disclosure of CSR data will take place. We are 70–80% of the way toward that. The EU is about to require mandated social disclosure throughout the EU, and I don't think the rest of the world will be far behind. Fiduciary duty. There is an increasing talk of how concepts of fiduciary duties may need to be re-examined, particularly the duty to serve for pension funds and others to serve future generations, to not prejudice the present generation over future generations. Complicated topic, but really worth thinking about. And finally, alternative measurements of success in investment. How do you measure shared value? Who is creating more shared value than another? Big topics. If those three things happen, we'll have actually a real effect on the financial community. Let's say one quick word about performance. This is the KLD index, Domini index. It's now part of MSCI. That was created back in 1991. It is outperformed versus the S&P 500. What I want for those of you who are technical, I want to refer you to this article here. This is done by a fellow named Dan Bartolomeo, who runs an outfit called Northfield. It's a performance attribution outfit like Barra, and they did a long-term performance measurement in terms of performance attribution. Adjusting for risk and other factors, there is no statistical difference over the first 18 years. They did this over the first 18 years. My view is exactly that. Managed properly, balancing the financial and the social and environmental property, you can get comparable competitive returns. We may want to talk about that some more, but that's my basic position. So what do you get with responsible investment? You get a shared value in addition to whatever your financial returns are, positive or negatives. You get a shared value. So a couple of very quickly about Domini. We have a focus on sustainability and what we call human dignity. Basically, we screen out alcohol, gambling, tobacco, the traditional sin stocks. We screen out military, primarily on the basis of nuclear weapons, and we screen out nuclear power. We also look at, in the rest of the universe, we give preference to companies that have a strong alignment with what we call our investment standards and strong stakeholder relations. Basically, we screen out about 40% of the investable universe among publicly traded stocks on the basis of these. We believe that doing that can help us create shared value by avoiding company-specific risks. So, for example, we were not invested in BP prior to the spill in the Gulf. We believe that it may help prevent systemic risks. Systemic risks are risks like risk to the financial community by some of the collateralized debt obligations and the credit default swaps that were used. We have a bond fund. We do no derivatives in that at all. Also, climate change is a kind of systemic risk. We believe everyone must think about and understand what the risks of climate change are and try and avoid them. Incidentally, just to answer a question which will come up, we do not currently have a fossil fuel-free screen. So, but we are, I'd be glad to talk about how we handle that climate change risk, which is short of a complete screen. And finally, we look for innovative and forward-looking companies, companies like Unilever, Philips, etc. We also engage with companies. There are a whole variety of tools we use. We have somebody whose sole job is engagement with companies. We've engaged with Gap on vendor standards. We've engaged with Yahoo on censorship, operating in China and companies with censorship. We've engaged with Nucor, a steel company, on slave labor in their supply chain. And we believe that all of these lead us back to this shared value. So the question in my mind, I'm going to conclude at this point. Again, apologize for rushing through all this, but we're glad to answer questions. I'm going to conclude at this point by saying in the past, investment and management has essentially confined itself to compliance and charity. The question for the 21st century is, can we move from compliance to risk assessment? Can we move from charity to shared value? In my view, the problems that we will face in the 21st century are of such a scope, and finance these days, which controls approximately $200 trillion in assets, has such a huge influence in this complex world that unless we are doing these two things, we will not be able to either compete or as a business or thrive, let me put it that way, thrive as societies in the 21st century. And I look forward to discussing with you and hope that you share that view. Thank you.
Thank you, Stephen. And right here in a few moments, Lauren's going to get Mr. Dan Aaron's presentation set up, and then we'll have Dan address the group.
I can go ahead and speak. Thanks for having me, Paul. I am, of course, here to be the counterpoint to much of what Steve said. As it was brought up in my bio, I created a mutual fund back in 2002 called the Vice Fund. It got a lot of notoriety. Wrote a book called Investing in Vice, and as Paul talked about, the recession-proof portfolio of booze, bombs, bets, and butts. But rather than just being the bad guy, per se, of course, I no longer work there. My current firm, Advisor Shares Investments, is a sponsor of actively managed ETFs, exchange-traded funds. One of those funds is even the Global Echo Fund. It is a sustainability-focused, multi-asset exchange-traded fund, much, much smaller than anything that Domini's doing, because we're just getting up the ground. These guys are the leaders in that field to a large extent. But it really focuses on positive screening. It has a few managers. They seek out various positive stocks to invest in rather than just boycotting the alcohol, tobacco, gaming, defense stocks, etc. And it's also aligned with Philippe Cousteau and his Global Echo Foundation. Actually, 40 basis points every year of the assets that are managed within the fund go as a charitable contribution to that Global Echo Foundation, and they are doing positive things, impact investing with the money they get from that fund. So it's not simply a matter of investing and boycotting stocks. They're trying to do something positive with the money in that fund. So I'm a big fan of sustainability. I'm a big fan of recycling. I'm a big fan of clean water initiatives. But I think investing, the point of investing is to make a profit. Now, profit's not bad. Why do we invest to make a profit? For our retirements, for our kids' education, all the positive things where we invest to make a profit. That's the point of investing. Otherwise, you just put your money in the mattress if you're not going to invest to make a profit. So, in the early 2000s, I was managing a few mutual funds that were sector-based mutual funds. What that means is we were rotating sectors. We were looking at, we had heavy investments in technology at that point, healthcare, financial stocks, even South Korea. And over time, we would rotate those sectors. And what happened in 1999, 2000, for those of you that remember, the market fell off a cliff. So, in managing money and always studying the various sectors of the of potential investments, I noticed something. If I looked at the 3-year, 5-year, 10-year performance of certain sectors, and I looked at the top 10 ranked sectors, what did I see? Tobacco, alcohol, gaming, defense. I was like, wait a minute. Those are all the primary sectors that the socially responsible funds are boycotting. Now, to their credit, as Steve said, there's been a firm like Domini, Calvert Investments. They've constantly grown and changed. They've turned their focus to be much more proactive towards sustainable investing, towards impact investing. But the fact remains, one of the primary things they do is called negative screening, and screening out alcohol, tobacco, gaming. A confusing one is defense. If we are boycotting Lockheed Martin, General Dynamics, Raytheon, are we not supporting the military? Is it almost unpatriotic to boycott defense stocks? It's at least a question and a slippery slope. I don't know, and I'm not here to answer that. So, again, investing, the point of investing is to make a profit. I would like to say that a lot of the companies that are negatively screened or boycotted by a lot of socially responsible investors may be pretty socially responsible companies. How many people in this room enjoy having a glass of wine? Think it's okay to have a glass of wine? Get them up, get them up. I do too. A lot of individual investors that choose to invest in a socially responsible fund like the sound of being socially responsible. Who doesn't want to be socially responsible? We're against pollution. We're against corporate greed. We're against waste. We're against sweatshops. We're against a lot of those things, but we like to have a glass of wine. So why are we buying a fund that's one of the primary things it does is boycott every alcohol producer? So let's look at some numbers. Because I said the point of investing is to make a profit. Uh-oh. Oh, can we make it full screen? Or? Brown-Forman Corporation. Anybody heard of Brown-Forman Corporation? Anybody heard of Jack Daniels? Yes. Jack Daniels, Woodford Reserve, Finlandia Vodka, Southern Comfort. Looks like it went up about 275% in the past 10 years, while the S&P 500 went up, I don't know, 75, 80%. That's a 10-year chart, exactly 10 years. Just an example. Now, I will admit I'm cherry picking here, but I am looking at pretty much the largest, most well-known alcohol producers. Diageo Corporation. Anybody heard of Diageo? Let me remind myself, everybody, that Diageo is. Diageo. Sterling and BV wines, good stuff. Guinness, Harp, Red Stripe, Smirnoff, Kettle One, Crown Royal, Johnny Walker, Captain Morgan. Those are all Diageo. Once again, performance. I have another. And again, these stocks are pretty much the largest cap stocks in the alcohol industry. Bud, Anheuser-Busch, merged with InBev, and now owns not only Budweiser and all the related brands, Stella, Corona, Beck's, Spaten, Bass, Labatt, and about 30 other beers. Are they a sustainable, socially responsible company? Do you know who one of the world's largest recyclers of aluminum is? Anheuser-Busch. They are an alcohol producer, but in my opinion, a very socially responsible company with good corporate governance. No one's claiming they're polluters. No one's claiming they're ripping off investors. They're a very large recycler of aluminum. They do a lot of sustainable practices in their business. Yet, I like having a glass of Budweiser, or actually more Spaten, time to time. So, the slippery slope of alcohol. Now, I mentioned defense stocks. That's a little bit confusing. Are we patriotic? Are we not patriotic? One of the largest cap stocks, Lockheed Martin. They make all those fighter jets, F-15s, now the F-35. That's about 230% profit in the last 10 years. Of course, took a big dip like a lot of things did in 2008. Once again, compared to the S&P 500. That's the stock I want to own. While they make airplanes, General Dynamics makes tanks and lots of other things for the Army. Good stock. Another, again, 10 years, something I want to own. Gaming and casino stocks. Socially responsible, not socially responsible. How many people think it's okay to go hit the casino and have some fun every once in a while? I do. How many people think it's okay to buy a lottery ticket? That's an interesting one. Do you know that private corporations, or not private, public traded corporations like G-Tech manage a lot of lotteries? What happens with those lotteries? Goes into the state budget. Sometimes it helps schools. Or very often what they do is they say they're going to add the lottery for schools, but then the wonderful legislators end up taking that money and using it everywhere else that they need money. But I think, one other point, MGM Mirage has built a number of LEED certified buildings in the last few years. Does everybody know what LEED certification means? It's another very important thing that I'm a fan of in architecture and building construction. You get various levels of LEED certification based on how energy efficient. Even if you have bike racks, there's lots of things. The windows, the energy efficiency, how much renewable energy you're using. Lots of things go into LEED certification. MGM's now building LEED certified casinos and hotels. Are they a socially responsible company? They're a gaming company. Gaming's been around for millennia in various forms. Not exactly recession proof. Oops, that's the wrong one. Because gaming stocks had a little bit of a bubble and fell really hard around 2008. This is Wynn Las Vegas, also the Bellagio, the Borgata. There's a number of Wynn. They're also in Macau, China, as is Las Vegas Sands Corporation. Here we can see the bubble. These stocks got way too hot and fell rather dramatically. But still, for a 10-year number, not bad. Not beating the S&P, but it's on its way back. Depends on what time frame you're looking at. So, In that wonderful book that I wrote, The Booze, Bombs, Bets, and the Butts get to be the elephant in the room. How many here people think tobacco is a good thing? Thank you. They'll kill you. Terrible. I don't think anybody will agree that tobacco is a good thing, but it's legal. It's legal, right? Personally, I'm a little bit of a libertarian. I think if people want to smoke cigarettes, they can. But then we get into a real slippery slope discussion again of what it does to the healthcare, the entire healthcare debate in the United States, or in the world for that matter. Does somebody down the street smoking cigarettes, getting lung cancer, hurt all of us in the pocketbook? Maybe. But at the same time, don't double cheeseburgers do that? Should they be banned? I don't know. Do you guys invest in McDonald's? I don't know. So I'm not here to. I'm here only to raise the question. Tobacco. I don't think anybody will agree they're good for you. Lawsuits. But how many people think tobacco is a good investment? For those that don't know, I might blow you away with something here. Altria, Philip Morris, which is mostly Marlboro and lots of other brands. Oh, and by the way, what does Philip Morris do? Copenhagen and Skoal, all the smokeless stuff. But they also own wines, another sin stock. Chateau Ste. Michelle, Columbia Crest, lots of other wines, but primarily Marlboro. Now, that's a pretty outrageous number. Tobacco stocks have been extremely recession-proof. Now, on the surface, we all should think tobacco stocks bad. You know, they'll kill people. We all know that. Smoking bans. I mean, it happens state by state, city by city. I think it's nice that we can go into a bar and restaurant and not be inundated with cigarette smoke. I like that. But it doesn't make sense. Why is that stock doing so darn good? Well, does anybody ever see tobacco advertisements? No, they're not allowed to advertise. We see states increasing all the time sin taxes. So if they say, let's increase the tax on cigarettes by an extra 10 cents a pack, do you know what Philip Morris does, Altria? They add an extra, they increase the price of those cigarettes 10 cents, plus 2 or 3 cents more add more to the profit margin. The most profitable consumer product in the world is tobacco. The profit margin on cigarettes is higher than any other consumer product. They have a huge barrier to entry. Altria, British Tobacco, Imperial Tobacco, Reynolds, Lorillard. There's about 5 big tobacco stocks. No one else can get in that industry and compete. Do you hear about any entrepreneurs starting up? Hey, I'm going to get in the tobacco industry. No. So we have huge companies making billions of dollars in profits, huge barriers to entry. They have no competition, and they have built into them the highest profit margin per sale of any product. They pay huge dividends. So these are very stable, old school, blue chip, dividend paying stocks that unfortunately most of the socially responsible funds are excluding. I think as long as it's legal, invest in it, make a big profit, and donate your profits to cancer research for all I care. I think it's a smart thing to do. So that's the performance of these stocks. Now, here's where it gets interesting. So I created this fund back in 2002 called the Vice Fund because all those industries popped up. We did a little research. We're like, hey, those exact sectors may be a good way to invest. Now, is it a gimmick? A little bit, whatever. Calvert, Domini manage billions of dollars. That Vice Fund still exists. It has like $300 million in it. That's small. That's very small. But it's been a great performer still. But how many people in this room are invested in Altria, Philip Morris? Anyone else? Is that about all? I think every one of you is invested in Philip Morris. Every single person in this room, I think, that's maybe some of the students don't have anything. Sorry. Are probably invested in Philip Morris. Steve might not be. Here is why. Altria, Philip Morris, Capital Research Global Investors, that's American funds. Vanguard Group, State Street. State Street is SPY, by far the biggest fund in the world, trillions of dollars. It's the S&P 500 ETF, State Street. BlackRock is iShares, iShares ETFs. Then we go down to Fidelity, Northern Trust. It gets a little more complicated after that. So, do we think, am I invested in those? Well, I don't know. Let's look at this. The Arizona State Retirement System. This is just the equity subsector. Has about $18 billion in the equity portion of the Arizona State Plan. 8.82% of it is in the S&P 500 Trust. The S&P 500 Trust owns tons of Philip Morris. Then we own Exxon, Apple, Microsoft, Chevron. Steve's fund also owns Exxon, Apple, Microsoft. Maybe not Chevron, I don't know. Good. We go a little bit farther down. Vanguard Total Stock Market ETF. iShares. A little bit farther is another iShares. The S&P 500, Vanguard, iShares owns tons of Philip Morris, tons of British Tobacco, tons of Diageo, Lockheed Martin, General Dynamics, Budweiser, Diageo, all those stocks I just mentioned. We're talking billions of dollars here. And you don't seek to invest in those stocks, but everyone is invested in those stocks. And if the state of Arizona chose to divest itself from the S&P 500, it would just be a blip still, because the S&P 500 would still be, by far, the biggest fund in the world. Trillions and trillions of dollars is invested there. So, some of this, one of the biggest socially responsible funds, although Steve pointed out Parnassus now has a whole lot more. This is Calvert. This is the Calvert, what's the name of the Calvert fund? The Calvert, it has about $2.6 billion. This is its 10-year number. Oh no, this is since 2002, because I wanted to compare it to the Vice Fund. 2002 to 2014, that's about a 12-year period. The S&P 500, sorry it's not labeled, went up 145.33%. The Calvert fund went up 107%. The Vice Fund, S&P 500, I just said it went up 145.33%. The Vice Fund, seeking out alcohol, tobacco, gaming, defense stocks, it's gone up 215%. The purpose of investing is to make a profit. Then donate your money to good causes. I like to donate my time and money to good causes, but I don't have to impact it in my investing. And that's all I have.
Thank you, Dan. So now we'll transition, and we'll have Chris wrap it up for us here, and then after his presentation, we'll move into the Q&A session. Chris?
Okay, thanks very much. It's very interesting to see these two presentations before me. And I just put together a few thoughts, and then I also this morning looked at my Bloomberg screen to try to see how easy it would be to isolate these socially responsible criteria. And so if time permits, I'll talk a little bit about that as well. So So as Paul mentioned, I had the opportunity to work on an endowment as part of the investment committee. And many of my thoughts and comments today will simply be a function of that personal experience. I have not done research on socially responsible investing, so I'm not speaking so much as a researcher as a practitioner today. My first slide notes that in the investment world, the thing that surprised me the most is the layers that separate the person who's investing money from the owner of the fund. It's quite an interesting set of layers. So for example, as I mentioned, I served on an investment committee which had the fiduciary responsibility of worrying that the funds were invested in a meaningful and efficient way. We hired a chief investment officer who then went out and implemented the policies that we wanted to put in place. What most chief investment officers of plan sponsors, that's pension funds and endowments and so forth, what most of them do now is they hire a consultant. And the reason for that is that it's an extremely complex world out there. There are alternative investments, there's traditional investments, there are aspects of constraints such as we've heard today on portfolios, and consultants have access to data and data screening tools that are too expensive for chief investment officers to obtain. So we have this additional layer here. Now if we go to the alternative investment space, what the consultant typically will do is hire a fund-of-fund manager. This would be, for example, a hedge fund, but it's called fund-of-fund. And then the fund-of-fund manager, in turn, hires individual fund managers. So it's quite a huge, up here at the very top would be the worker, or the retiree, or the donor. These are people who are ultimately interested in the outcome of that investment. But you can see there's quite a few buffers that separate the investor and the money being invested. So one thing that concerns me as an observer of this process, and put someone who has fiduciary responsibility back up here, is that the natural question I have is, why are there so many buffers? And I think one of them is because we're afraid to take responsibility. It's difficult to fire somebody here if someone down here does a bad job. And so when we have all these degrees of separation, then it becomes harder to hold individuals responsible for outcomes. But another thing that struck me and that I observed is the opportunity for self-dealing, which is, of course, quite unethical. And I believe, for example, that consultants might look to specific fund-of-fund managers because they afford certain benefits back to the consultant. So I do worry about the structure. That's actually my first order of concern in the investment arena in terms of the ethical environment. It's not how the money, what the companies are doing, but it's what this process is doing in terms of the fiduciary responsibility back up here. And I would point out the investment committee can do very little about that process. That's really outside of our scope. So you think about the investment committee and the things that I was responsible for. We are responsible to implement broad objectives such as asset allocation. How much do we want in fixed income? What are our broader objectives? If we're an endowment, we're worried about a very long-term horizon. We're not worried about year-to-year, month-to-month variations in the market. We want to make sure that this pool of funds is around for a very long time to achieve a certain set of objectives. So that's generally dealt with in the area of asset allocation. We also can deal with specific constraints that will push through that channel. The example that Steve mentioned is South Africa divestment in the 80s. That's probably the most famous, and we don't know whether it was ultimately successful, but certainly we did see change brought about, and many argue as a result of, or at least it was sped up, because of investors eschewing South Africa in light of the apartheid conditions that prevailed. So as I say, these things are also the purview of the investment committee. Now, Steve mentioned, and this to me is very important, he mentioned it's a very complex issue, and I agree it is, but I think it would have to be dealt with in order to understand how we would ever implement socially responsible investment. And that is any constraint, such as the South African constraint, that the investment committee is going to push down through that channel has to be reconciled with fiduciary obligations. So if I'm sitting on that investment committee and I'm responsible to the donors, say of an endowment, is it the case that I can honestly say to the donors and to the university that by not investing in this set of stocks or this portion of the universe, that's fulfilling my fiduciary obligation of getting the best return for the lowest risk? So that's a critically important question. I don't know how to answer that, although I'll have some additional thoughts. But I don't see moving forward until I can understand that question. And I think that's critically important. Now, once we get past that, then the mechanics of implementing any of these objectives is straightforward. The investment committee simply articulates the constraint to the next chain down and down all through the lake. And then we do see that all of these managers are quite responsive because they have sophisticated software, and they can say, yes, we will happily take your constraints and embed them into our allocation model. And when we did, if we were hiring a manager, we would, in our request for proposals, ask them right up front whether they would be able to implement our investment policies. Right? Are your software applications sophisticated enough such that if we say do not invest in stocks X, Y, and Z, even though stocks X, Y, and Z are in the S&P 500, for example, that you'll be able to implement those constraints. And so that's actually a fairly straightforward issue here. Now, as I said, to me this question of fiduciary duties is the most important, and fortunately I do have some personal experience working on an investment committee for over a decade. And thinking about the questions that we dealt with and how I approach that set of responsibilities, I think the first order problem is our investment objective. And to me, sitting on the committee, I personally, those of you who know me, know that I'm very conservative. And in my own personal investment, I'm much more conservative than I would be in the universities to have. So one of the things that I had to do, as I say here, is to suppress my personal biases. My own utility function, my own biases, I have to set aside. I said, look, this fund is here to achieve a set of objectives. In order to meet the fiduciary obligations that I have to take more risk than I personally would be willing to do. Just as one example. The one thing I do know is unambiguously my goal as a fiduciary is to keep fees as low as possible. One of the fears I had is running a large portfolio is, think of the problem. If I hired vice funds and socially responsible funds, I'd have the market probably. But I'd probably be paying a lot more in fees than if I bought the market. Because I could buy the S&P ETF. I think on the Vanguard ETF, the fees are less than 10 basis points annually, right? It's probably about 7 basis points a year. Whereas if I bought both of these, the fees would be closer to 100 basis points total, and I'd have replicated the same portfolio. So you've got to be careful about that. We do have this inclination to diversify, but oddly enough, you know, the fees don't diversify, they keep adding up. As I said, one thing that strikes me as an outsider to that process is how ripe it is for self-dealing. And, you know, we've done a lot over the last 30 years to try to mitigate some of these problems. 25 years ago, everybody had soft dollar accounts, for example, which were the devil's handmaid for self-dealing practices. So I think in most cases we've done away with a lot of those things. But, you know, we still have all these buffers, and one of the things that those buffers do, in my opinion, is create opportunities for self-dealing. The other thing is, as a financial economist, our goal oftentimes is to identify earning returns in excess of what we would consider fair compensation for the risk that we're taking. Most managers that I talk to now, again, the world is becoming more efficient in many ways. Most are becoming a little more skeptical of generating what we call alpha. It's really hard to do. So what we need to understand, I think, as a fiduciary, is what is this fund's risk tolerance? What is the overall risk that we're willing to take on? And where am I going to be able to generate the best return to compensate for the risk that I'm willing to take? So I think of it as shifting from trying to identify alpha generation or generating return in addition to what we would hope to cover our risk, to risk budgeting in another way. So I think of that as one of the ways that risk has changed the environment. Now, assessing socially responsible investing, you know, it's a difficult problem, and I mentioned that I don't do research here. Part of the reason is because it's a really, really difficult problem. And one of the reasons is that, you know, it's very likely that over the next 20 years, some of the stocks that Steve's fund is stressing, and some of these companies, are going to do very well because they're on the cusp of what become very important trends. I don't know what the next big source of energy will be. I'm pretty sure it's not going to be coal, for example. There was actually a big story in the Wall Street Journal on Tuesday of this week about funds that are actually turning away coal. I mean, you'd hate to be a coal company going out trying to find investors because it doesn't seem like many people want to invest in it. But one of these upstart companies, probably in a technology that I've never heard of, is going to take over the production of energy by the end of my lifetime. And so these funds that are dabbling in those areas are going to be on the cusp of that technology. Underweight in coal, obviously, which is what socially responsible investing is focusing, for example, on recently, could be quite a brilliant strategy. Now, as you think about this, I don't know if any of you guys have heard of William Ackman, but he's been very active shorting Herbalife stock. You mentioned, I think, Paul even, Ponzi schemes. And William Ackman argues that all Herbalife stock is a big Ponzi scheme. And so he's taking, in a sense, socially responsible investing to the extreme. I don't know if it's reductio ad absurdum, taking it to the extreme of absurdity. So he's going out not only not buying Herbalife. It's not like he's managing money and says, I'm not going to invest in Herbalife. He's short Herbalife. He's shorted probably to the tune of its own market cap. That's a big short stake. Then he's going out and publicizing all the bad things Herbalife is doing. He's using his position as a large investor to provide a forum to try to essentially break down Herbalife stock. It's almost like, as I said, if I really didn't like coal, I could, and I was somebody like William Acton, I could do something like this. So I think that's kind of an intriguing thought experiment, if nothing else. Where does this all go? What's the end game? So concluding this set of slides, in the big picture, socially responsible investing constraints, to me as a fiduciary, were not a first-order concern in terms of performance. The more complicated issue from a fiduciary problem is whether I as a fiduciary could rationalize them as representing the investor's priorities. Think of the donors to the University of Arizona over the last 30 years, the last 100 years. Is it fair to say that all of them would say, yes, I'm very comfortable with you not buying Raytheon stock? I don't know. That's a difficult problem. As a fiduciary, I'm not sure I'm well suited to answer that question. So that concludes the set of slides that I put together as I thought about this. And as I mentioned this morning, I just looked at my Bloomberg screen thinking about today's meeting here. And I wanted to show you what I can pull up with just a few seconds on Bloomberg. So I looked at one of the companies I actually am currently writing a paper about called Maxim Integrated Products. It's a Sunnyvale, California-based producer of linear and analog semiconductor chips. And one of the screens that you can see here is that I have this socially responsible investing set of screens. And you can see here across the top. This says here it's ESG screen. ESG for environmental, social, and governance, as Steve mentioned. And then I have this set of tabs across: overview, environmental, social, governance, executive and director compensation, even to the point, now you can imagine how much I like this as a finance professor, ESG ratios, right? So all of my students over the last 30 to 40 years would probably be cringing to see that ESG is now something where there's a set of ratios which we can pull off right on my Bloomberg screen. So at the touch of a button, I can screen all of my favorite companies for this set of issues. You think this is the overview screen. So Bloomberg has, for each of the past 6 fiscal years, ending fiscal year 2013, an ESG disclosure score. As Steve mentioned, the question of how much am I even being told varies across American companies today. So Bloomberg first starts with how much information are they giving me, and they give a score for each company. Then I have an environmental score, so they actually score. Here, again, this is somewhat not a really fair thing. This company makes semiconductor chips. So they have a pretty good environmental score. Social disclosure, they have a score here. We have number of employees. Maxim is a reasonably large company, has over 9,000 employees. And then we also have governance scores. And then I can click on each one of those sub-headings under ESG. And those are the issues here. So here's, for example, environment. This is the set. You can see it scrolls a little bit down, and I could just pull one screen. I didn't want to shrink it, so it's probably still hard to see from where you are. But you can see, here's the ISO 14, or I guess that's 140,000 certified statistics, and you can see whether or not, or the sites rather, so how many sites are certified by ISO. Then you can see whether or not they are scored with a yes or a no on all of these environmental criteria. Do they have water policy, waste reduction, green building policy? I wanted to get across, this took 10 seconds for me to get. Less, right? Type in Maxim, click. ESG, click. This screen, click. So I can see all of this information with the touch of the thing. So it's all available for us today. And we can screen on this if I'm interested as an individual. Very easy for me to access that information.
Okay, so that concludes the presentation portion of our panel here. I want to thank each of you for doing just a wonderful job managing your time. now we get to the Q&A session. So I've got a microphone here, which actually I think we'll keep the microphone here. I'm going to kind of open it up to questions. And ideally, we'd like to try to get through as many questions as we can in the next 20 minutes. So I'm going to ask our panel as best you can, try to really find kind of the essence of the question and answer it so we can kind of move through a series of questions. So with that, do you have any volunteers to start us out? This is just like class. Nobody. Here we go. Doug, please. Sure. I'll go ahead and pass them on. Yes.
I think here's a question that popped into my head as you guys were finishing up. And I think in particular as, I think it was Dan finished up. And you were talking about, hey, look, the purpose of investing is to make a profit, make your profit, and then go give to charity. And I guess here's what kind of came to mind. As we've built our company, community service and giving back to our local community has been a huge part of that. So quite frankly, the more money we make, the more we give back. So my question is this, and I don't know if it actually plays, if the numbers play out this way, but hypothetically, if as I move forward, I were to choose to invest in only socially responsible companies, but give up a certain amount of profit because of that. That's because the assumption I'm making is I'll make money, but I'll make less money than I will if I invest in the Vice products. And if I make less, but I'm doing better for the world at large, and say to myself, well, I made $50,000 less this year because of my investment choices, so I'm going to give $50,000 less in charity to my local community. What kind of overall impact does that have in local communities, nationally? Is that something that you guys kick around?
I think first, I don't think you need to assume that you're going to make less. And I think you have to walk on 2 feet. You have to look at the social side, and you have to look at the financial side, and you have to. There are certain circumstances in which you might be able to think you're going to make as much or more, or in circumstances where you might think you're going to make less. But you just can't tell in most investments whether you're going to make more or less to begin with, and I don't think you should set about investing and thinking you're necessarily going to make less. In terms of charity, I don't think it makes a lot of sense to invest in a tobacco company and then give to a cancer society. That just doesn't make any intuitive sense to me. So that's in terms of that question. In terms of supporting your local community, I don't see why you could say, I didn't make so much in my investment this year, and therefore I'm not going to give so much to my local community. But that could happen with any kind of investing that you do. It doesn't have to be social investing. So, and that's your choice in terms of how you allocate your money on your investments. And to me, it doesn't quite have to do with it. It's very rare that you can say ahead of time, I'm going to make less money on one investment versus another.
And I'll actually completely agree that you don't know. You're not necessarily saying you're going to make less money. I was showing some alcohol, tobacco, stocks, and so on, but I was cherry picking. I was showing some of the big ones, but there's lots of very good socially responsible investments. A big point that I like to make, though, is that I hate to use the word slippery slope again, but it's a slippery slope. A lot of the socially responsible funds, 10 years ago, were famously avoiding alcohol and tobacco, but they owned Enron. That's a tough one. They didn't see it coming. So Enron wasn't an alcohol or tobacco producer. They weren't polluting, but they obviously had some other problems. So, I still think the part about buying a tobacco stock and then donating your money to charity, that was a little bit of a farce. But I still think an investment's an investment. I think if you're going to not buy Altria, I don't know. Does it really make you sleep? Do you sleep better at night? do you own it? And if you own it, are you supporting them? No, you're not supporting them. You're buying and selling a stock. It's just a thing. It's I don't think owning the tobacco stock is supporting the tobacco industry. It's just an investment.
Next question.
By the way, thank you for the topic. I can feel as I'm hearing the different perspectives, which I appreciate, that my internal compass is just spinning. I'm not getting a very clear, this is where I land on any of this. In fact, at a personal level, I own an F-150, I drink wine, and and I'm like, oh, shoot. And so it's a very interesting topic here that I'm trying to discern these new levels of gray, which I don't have clarity on. But I was shoot, I forgot what I was going to say. Too much wine, that's what it is. Really comes from, I remember being in both my undergrad program and graduate program in finance. I'm a CFO of a company today. And, the number one maxim was to increase shareholder wealth, right? And it was like preached to us. And probably all of us that have a finance background have that. So here I am in a management role, and that sticks with me. They didn't say, by the way, and consider these other things. And they do have a financial impact. Some are not very clear, and so we can't put them into the finance model, right, to do an ROI on them. So so that's changing. What I hear is going on is that is changing. I know with my sons who are in their 20s, they do value. They don't want the big car. They don't want the F-150. They're making considerations around that. And I know to attract employees into my business, they also want to be working for companies that have momentum around this. So there is an ROI, but it's really hard sometimes to see. And so I just want to make a comment around that. I also admire companies like Starbucks, who they position themselves very well. I go in and buy a $4 or $5 cup of coffee, and I sort of feel good about Starbucks. I'm helping this socially responsible company, and I really want their coffee. So, but anyway, so my question though, Steve, is to you: is as your fund has grown larger over the years, do you see that you have somewhat, or you end up in engaging in debates about lowering, if you will, or your standards to invest in companies? Or are there just so many social responsible companies out there that's an easy thing? Or have you had to sort of, is that judgment difficult, I guess, over the years?
The two-word answer is always difficult. Yeah, it's never easy. I would say there's not a single company in the portfolio that I could say this is a company without problems. And we are always, there is always a area of, well, there are always areas of gray, always companies that are on the borderline. I dread picking up the newspaper in the morning. What company that we own is going to be in trouble? So engagement is extremely important in this, because talking with companies, understanding what's going on, does this represent a cultural change at the company, or is this a one-off kind of thing, that kind of thing, making judgments. There's a lot of judgment calls that you got to make. You're making judgment calls with imperfect information. The most important things about these things are you're asking the questions of the company, you're communicating that these are important issues that we need to think about, that investors need to think about, that society needs to think about. The use of social investing as a means for public debate is, I think, one of the most important aspects of social investing.
Thanks. As Professor Lamoureux mentioned, there's some information that's available if you just know where to look about the funds, their economic responsibility, social contributions. But what advice, maybe just one or 2 points you can give to some of the newer investors, as the gentleman mentioned, the 20-year-olds, the late 20s, 30s, who really care about social investing and giving back to the communities? Where can they go to find information so they feel good about investing? Because as we mentioned, profits are kind of a negative term, but profits are good if they're put in the right places. So what's a little bit of advice you can give to the newer investors to help them feel comfortable about investing?
So who'd like to take that question?
I can give a couple of sources.
Sure.
So the Social Investment Forum is a trade association. It goes under the name USSIF, USSIF. Their website is a very good source of information. There are 2 conferences every year where, if you want to get an overview of what's going on in the social investment world, one is called SRI in the Rockies. That takes place in the fall. And the other is called, well, it's the USSIF conference. I forget what it's called. That takes place in the spring. Those are your best places of information to get an overview about what's going on.
I don't have enough for everybody here, but I brought some handouts. I have something called a copy of an article in the Green Money Journal with an interview with Philippe Cousteau, who is a fund that we're involved in. The Vice Fund stuff's in my past. But as Steve said, you can also just go to some of the big companies. He probably didn't want to overly tout his own company, but just look up Domini. Look up Calvert. Those are a couple of the big ones and they have very good information at their website. Now, one thing that I mentioned is I'm a little bit against, personally, the negative screens. I think it's okay to own an alcohol company, for instance. There are a handful of funds that do only positive screenings. That means they really seek out the alternative energy firms. They invest in Whole Foods. They invest in Starbucks. So they're not just an index fund that's owning everything except the Zinn stocks. There are some green funds, sustainable funds. So if you're interested in that type of investing, look at the guts of the fund. Don't just buy a fund because it's socially responsible and that makes you feel good, but you're the person that still enjoys having a glass of wine. Look at what that fund is seeking out. Look at what it's actually investing in and see if that's something you agree with.
I'd like the thought process from all of you in regards to the social inversion regarding Burger King just the other day and Walgreens. They both where does that fit? Because you're looking at ROI to your investors, and but then you're looking at the social side of it.
That's a topic that I've been very interested in. So corporate inversion, who'd like to?
One of my colleagues was on a panel on corporate taxes, and he's a lawyer, and the head of the panel asked him, if you were general counsel of a company, would you advise your company to look into to minimize its taxes or not? And one of the interesting things is looking at, say, for example, a company like Johnson & Johnson. Johnson & Johnson has a credo, and part of its credo is to say, it says, pay our fair share of taxes. And, what company would put into its credo, its mission, don't pay our fair share of taxes? I mean, I think companies have an obligation to do that, and that's what they should be doing, and I think the bad publicity that those companies have been getting is perfectly appropriate. And it does show the limits of the maximize your profits at any cost. We live in one of the questions that I think as you want to ask is, if everybody does this, what would happen? And if nobody pays their taxes, no corporation pays their taxes. It's not a world you want to live in.
Chris, do you want to add a thought?
Very briefly, I mean, taxes would be a source of distortion in the economy, right? So, no, I mean, when any tax will distort behavior, people behave differently with the tax in place relative to no tax situation. Now, I actually believe that the corporate tax on corporate earnings is a very distortionary tax. Creates behaviors and outcomes that are very unanticipated. These are the laws of unanticipated consequences resolving out of that. My preference for U.S. would be to move toward a value-added tax structure. This would prevent this whole set of issues. There's there's the tax inversion that you mentioned, but it's already implicitly driving corporate behavior. There's trillions of dollars that American companies have parked so-called overseas. This could be invested at the New York Stock Exchange, but it cannot be invested in capital in the U.S. without crossing the border, in which case there would be a tax on it. So we're already seeing there's a huge amount of distortion that the corporate income tax over the years has put on. Most economists, myself included, would generally prefer not to treat the corporation as an income-earning entity and just pass that through to the owners or the lenders, whoever else is the beneficiary, but to tax the value added. So I'm not talking about reducing taxes net one way or the other, but the question is the structure and the way we tax, whether we're imposing additional distortions that might have consequences that we don't really understand. So that's, I think, the issue here. Now, I like the comment about the gray also, because what's happening is, first, if you can chase them, you got to measure it. So now we're measuring things that nobody measured 20, 30 years. That's like the first important step. And now, then it's got to come down to some kind of bottom line. There's a Kentucky farmer named Wendell Berry, maybe some of you have heard. But he actually says the problem in our society is the accounting. Now, I'm not an accountant, but we don't account for pollution. We could. It could be part of your bottom line. It's clearly if we get to a carbon footprint tax or something like that, now you're getting very close to saying one of my expenses is the amount of carbon production. So it's all a question of accounting. What do we as a society want to achieve? And I think that's the same issue with corporate taxes. And it's a question not of what is the outcome, but how are we affecting behavior by social policy.
Now we've got some students in the audience, undergrads and MBAs, and I don't want to have you not have an opportunity to ask a question. So do we have any of our grad students or undergrads that might have questions? Okay, Sharon, back here.
Thank you. Yeah, thanks to everyone. I want to say thanks to Dan Ahrens for coming, because it's always probably more difficult to be the one who stands out on a panel, and you can't have good conversation without that, so I appreciate that. With that said, my question is for you. So I'm an MBA student, and we had one of our weekly happy hours last night. I'll be the first to admit that the couple beers I had made the night even better. And so I love that point about alcohol. The flip side of that is I grew up with a family that had a lot of problems with alcoholism. And so one of the concerns I see as people who care about socially responsible investing is if you have a finance industry that's driven for profit focus, it encourages companies to focus on profits and not necessarily pay attention to, am I as an alcohol company facilitating alcoholism in any way? And that's one of the concerns, the big picture, the long-term sustainability concerns. It's along the lines of the concerns that I see for socially responsible investing. So my question is, I imagine your response is investing is for profit, and I think that's a completely understandable response. My question is, have you seen for vice investors an encouragement for companies like alcohol companies to say, donate more to philanthropic concerns like preventing alcoholism, so that way your image isn't tainted? What kind of responses have come for people in your investment industry to the growing socially responsible movement?
There's laws in the United States, obviously, that have a big impact. And I don't know if Anheuser-Busch and Diageo and Brown-Forman would be as forthcoming with education and commercials about drinking responsibly and all that if they didn't have to. I don't know what they would do, but I think they've been forced by society to be ever increasingly responsible. Now, I don't know, it's a can of worms that most of the people in this room enjoy having a beer or a glass of wine. The founding fathers of our darn country were drinkers and alcohol brewers and so on. It's in my silly book. So, alcohol consumption's not going anywhere. Everybody's going to agree that you should be responsible. But I think that by society, by laws, Anheuser-Busch, Diageo, Brown-Forman, they do a great deal in trying to act as a responsible corporate citizen. They do a lot in education. They donate money. They're involved in good causes. Again, I can't answer if they're forced to do that or they're doing it by their own judgment, but I would say they've moved in that direction a great deal. Does that answer your question?
One thing that's kind of a response to a lot of the concern of the public. Pretty much what my question is getting at. What responses have you seen to those kinds of concerns?
I've seen the alcohol companies move in that direction. Now, once again, I haven't been involved in this fund since 2005, but I personally believe, just being in the investment industry, the same as Steve and everybody else, I think those companies are acting more responsibly, ever increasingly so.
Okay, and this will be our last question. So,
I wanted to follow up on the comment that owning a stock doesn't necessarily equate to supporting that company or industry, but kind of following that train of thought, what impact have you identified through this growth in socially responsible investing?
First, I attribute the single greatest impact of the responsible investment movement the increase in data that's available on companies. So the data that you were talking about that's on Bloomberg, I can't overstate the importance of the data. That's the fact that that data is now on Bloomberg terminals. It means that every analyst in the world needs to at least decide whether or not they're going to take that into account. Whether they do or not, it's not. So that's the single greatest thing. The second is that I think that we never have, and I don't think ever will, make an argument that we affect the company's stock price or cost of capital as such. I think that where our primary contribution is raising issues for public debate. And the fact that during the South Africa debate, that every time a university divested, it was on the front page of the new university, it was on the newspaper, it was in the news. The fact that we are having this debate here today about these reflects that kind of thing. So those are the two main areas. Then there are a lot of one-off little accomplishments, but those are just one company by company.
well, and with that, that's going to conclude our symposium. I'd like to thank each of our panelists for both Dan and Stephen. They came in from out of state, and we really do appreciate that. And Chris, we really appreciate you also taking time. We have some gifts for you here. You have some license. No.
No Arizona wine?
No, what you have there is a Eller College Management Center for Leadership Ethics polo, which I hope you wear.
Yeah.
And you also have one of our little pins for your lapel. So how about a round of applause for that? Again, I want to thank all of our supporters that made today's event possible, and of course our sponsors, Vantage West, and of course, Zanesville. I want to thank you. So around to our... You might have noticed that we had a recording going, so in the next couple of weeks, perhaps a month, we will be able to take this recording, put it on our website for viewing, so if anyone didn't get a chance to come to the symposium or you'd like to pass it along, it's in our CLE website along with the other symposiums we've had over the years. So make sure that, in fact, we'll remind you of that in the follow-up email once it's available. And I'd like to ask all of you, since you're all friends to the college, to mark the date, October 24th. This is when we're going to run our next center program. It's our collegiate ethics case competition. And actually the case, it's funny that it came up in the discussion, is going to be centered on corporate inversion. So I think we are in store for a wonderful competition. I can't wait to see how the very best undergrads in the U.S. and from Canada are going to wrestle with this particular issue. So I will be following up with many of you to serve as judges. You'll be supporting us in different ways. I want to thank you. I want to ask you in advance to support us in the future. And with that, I want to just wish you the very best. Enjoy the long Labor Day weekend. I know that I've made it a practice, as I'm sure many of you, to remind not only students but our kids about the whole reason why we're celebrating Labor Day. So make sure that you continue that, because I think as time goes on, these holidays that we have get further and further and further away from the actual intent and meaning, so I think we all have a responsibility to reflect on it. So thanks again, have a wonderful weekend, and thank you.